February 3rd. That's when you're watching this. February 3rd, 2025.
Yep.
A lot going on. Jennifer over here, she told me this morning, and I'm going to paraphrase. She has more business under contract than she's had in years. Jennifer, expound.
Yep. So I closed one this morning, but this morning when I woke up, I had 8 bound contracts, which is the most I've carried at one time since 2022.
Which was one of a very good year.
Yep. And
Right.
I'm going to share something else back to back. I didn't share the stat from Jared James last week because I think I found it afterwards. Last year was a hard year. I mentioned that. I had 11 closings total. Usually I'm 20 to 30. And it was hard. And it's hard even for someone who knows what they're doing and feels good about how they're helping people, which I do, to go, gosh, God, are you trying to tell me, should I be in this? Should I not? Am I changing? What am I doing? And I saw a quote. Go look up Jared James if you need to know more about him. But it was 74% of realtors last year did 0 closings. And 2% of the realtors last year did 0 to 11 closings. And 0.74, I think it was 74 of the realtors did 20 closings or more. So, sometimes I think it happens to all of us. I'm sure, Mark, when you talk next week about like getting out of debt, you can't see the forest for the trees. I knew I was doing well, but also I'm in my bubble. I don't ask other agents how much they're doing. So to come out of it and go, okay, first of all, I got through it. I helped some great clients. I'm still in this business. I have no intention of getting out of this business, but it was a hard year. And then to go, wait, I was in the top 2% of productivity realtors nationwide. Okay, I guess I'll take that. It didn't feel like it. Like when you're running a marathon, you sometimes don't know how close you are to the end.
It's the same with lending. They say that 70% of lenders are out of the business. So
yeah,
after 25 years, I'm still surviving. Last month, I think we talked about that last week on this channel. We had the highest apps since February of the year before last. So that's tremendous.
And in my ADD brain now, one of my favorite songs is in there. I Will Survive.
Yeah.
I love the movie The Replacements. That's one of my favorite movies.
Which one?
The Replacements, and that's one of my favorite scenes.
Very good. Mark, what's one of your favorite movies?
Oh my gosh, let's see, Braveheart, Die Hard, Top Gun Maverick. I mean, the list goes on. I have been known to quote Die Hard phrases like, if you're working on a project, someone comes in, the common phrase is "Welcome to the party, pal."
Yeah. Wait, hey, by the way, speaking of coming in, your audio is just a little dim today. I don't know why.
Oh, is it? Okay.
That's better.
All right. I'm talking over to the left.
No worries.
From the diaphragm.
La 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 la. I am not your singer.
All right. So today we're going to talk about pitfalls, I think, something like that. What was the title we came up with?
Show me the funding.
Show me the funding. Well, that's what we don't want to see right there.
How about this one? Sometimes that has to happen. You'll have to tell us about that.
The military wedding and lending.
That's where we really don't want to have happen.
Look, it's a rush.
And we'll talk about what happens if your car and I have stories from every single one of these.
Damn it, I quit. What? What?
Do you want to open a card and save 10% on your purchase? Absolutely. Today. And then you ain't buying a house.
Oh,
so do you want me to share my little blurbs from these guys and then you can tell us the comment? All right.
So what we're getting at is when you're doing a mortgage there, we've talked in the last couple of weeks, we talked about some of the things leading up to it. We talked about, credit. We talked about income. We talked about the process. We didn't get into credit. We can do a session on that. We didn't get into really how we figure income. We can do that. We didn't really talk about what underwriting looks at or processing or things like that. But what we're going to talk today about, and we'll go in this order, is when you start on the mortgage timeline, you start your journey, there's a couple of things you need to know now so that you don't make a mistake and fall into the "we can't do your loan" category. And so Jennifer helped out with that today. And this first image, Jennifer, Why is it? What is this? This looks like mattress money.
It is mattress money. And mattress money is my euphemistic term when I do my buyer's orientation. I said, don't be ending up with mattress money, which is money that is not sourced. You
Not
most
forceful
likely
money.
came through it legitimately. It's not like I'm running around with a bunch of people who are getting money nefariously. But if you are selling because you know you need money in this process, or you're working on your debt payoff with Mark, and you're selling, a bottle of Glenfiddich that you haven't opened and you don't have a receipt for it, or you're selling a car or whatever. The other thing, when it's around holidays, if it's coming up on somebody's birthday during this period, if it's coming up on Christmas during this period, sometimes Mother's Day and Father's Day and things like that, I ask them, are you by any chance expecting to get a cash gift from somebody? Because the lender has to see and know a source if the amount of a deposit is more than what?
Well, we'll get in a currency transaction and things like that.
Okay,
Let me
but
talk about.
there's a threshold that it pops and it's like, hey, what's going on here?
Yeah, it's usually about $2,000.
Yeah.
And I will say, if we have stacks of cash under the mattress, that's the money that we need to purpose to get it to work for you.
Well,
Right.
and that's what I usually say. I'm like, use that money. If you have money like that, use that for your gas, your groceries, your whatever, if you're selling something in the process,
So let me go back up one, Jennifer. Let me
Yeah.
expound a little bit on that. So people watch this, are going to go, what are you talking about? That's my money. I saved it. My parent, I can do
I
whatever
sold
I
a
want
car.
with my money. Well, you used to be able to do whatever you wanted with your money. And you may not know this, but after 9/11, which is 24 years ago, they
Crazy.
passed something called the Patriot Act. And the Patriot Act, what they discovered after 9/11, or they told us that they discovered, is that there was an extreme amount of money being laundered through real estate in our country. The money that people were getting to buy houses, we had one of the biggest housing booms prior to that. And after that as well, it kicked back up again. There was a lot of laundered money that they weren't able to source. So the government passed a bunch of laws to put in place that already would go with things like currency transaction reports. So if you deposit more than $10,000 in cash, or those things are going to be reported, or what's called structuring, where you make two deposits at different times of a day that total over 10,000. There's some things y'all can look up, but money has to be sourced. So when we're doing a loan for someone and they're bringing cash to the table, they say, "Oh, I'm going to be bringing $6,000." We have to.
I'm going to jump to another screen in the background because it pertains to. Go ahead. No, keep talking.
We have to find out where that came from. We have to source it, and we have to be able to show where it originated from and how it got to you. So if you do have stacks of cash, like in the first picture, and you're thinking about buying a house, it's okay to get that in the bank and have it sitting there for 60 to 90 days, because that is allowable. Money's been there for more than 2 months, 90 days. That's absolutely fine.
It's seasoned. It's been sprinkled with spices.
Absolutely. But when it's introduced at the last minute and you can't prove what it is, that's an issue. Jennifer, tell us about this barber chair.
So I had a client, a friend of mine, who's a hairdresser, and she's legitimately, there's a lot of cash transactions in that. And for the month leading up to her closing, we had to document her cash deposits, because every day she's getting considerable cash deposits. So, and she had a chair at a salon. So every day they had to run her till, her receipts in the books to match the cash payments from clients.
That's an example of a very good loan officers that you worked with at the time, because they knew to do that. I had a couple here in Nashville who works at a very fancy restaurant at the base of a very tall building in Nashville. Yep. And together they made $250,000 as 25-year-olds in tips. Okay. And they were very smart. They talked with me a year before doing this, and every night this particular restaurant pays out every night in cash. And every night they would go to the ATM and deposit that cash. And just like Jennifer said, to her clients had a month, we had a year of deposits, because it was a very large amount, to show what this young couple was making. And with that, we made their purchase, but we were able to source it. We were able to see the receipts from said restaurant that said they were getting paid the cash, and then they were able to deposit immediately. So we had a chain of, I guess you could call it a chain of custody. You want to go back a slide and we'll talk about chains of custody?
Well, let me ask you a really quick question about that before we get into this one. What about like somebody who's making, 10 to 50,000 on some of the sports betting platforms, because the payouts are listed there, it would still be sourced money, right?
Gambling is going to be considered self-employment, and you're going to need to see it on the tax returns for 2 years. So although people love to show their losses on taxes, they don't always like to show their winnings. But the new way it's reported, with as complicated as it is, I'm sure that's auto-reported. But in the past, we often would see the losses, which, by the way, sometimes those losses can be added back, Mark, if they consider gambling to be the profession and they're really bad at it. So,
okay, I have to tell you, and then we've got to book on. I was at a horse track the very first time I ever went, and this guy's horse hit. And next thing I know, he's like bending over and scraping up all these tickets off the floor. And I'm like, what? And my friend who had been before, because her dad had a racehorse, goes, oh, yeah, he's picking those up because those are losses. And he's going to take these losses off the ground and submit them with his losses. I'm like, okay, obviously not my wheelhouse.
Win. Yeah.
Yeah. All right. So you guys were both in the military.
Mark wants to tell us something about gambling.
Oh, yeah.
Actually, I was going to say, to go along with the barber chair, if anyone that's listening to this that is budgeting right now, to kind of go along with that theme, you might look at your budget and see where you can trim the extra, the extra money off your budget in order to free up some margin.
Well, and are you accounting for every dollar? Because sometimes people don't think of cash as money. Oh, I went to dinner and I paid $30 bill and Mark gave me 15, and that 15 is free money, not in my budget. It's called, some people call that girl math. I don't, but there's whole memes about it. All right. So you guys were both in the military. There's whole memes and jokes about military marriages. Get me out of the barracks, all that, right? BAH. And I know agents who have had to stand up at courthouse weddings. Like the wedding is planned for July, but the couple's lease is up in May and they're buying a house. And then they find out that the fiance, who's not in the military, their income can't be counted towards the loan because they're not married. So everybody runs down to the courthouse and gets married. Yep. And they don't tell the family about it until, like, they just let them think the July wedding is the wedding, because they have to be married for spousal income to count on a VA loan. So I've had that happen.
Well, I want to jump into something that's really, really important about this that through your comment that triggered a thought in my mind. That is buying a house when you're not married, and your partner, your boyfriend, girlfriend, or I'm just going to buy a house with my friend. Yeah, and it's happening
a lot because they don't have the money to buy a house solo.
Right.
Non-romantic partners.
Right, exactly. And the thought process is we can rent out the rooms that are in the house. And so I just want to speak to those that are listening that have been thinking about this. Don't do that. If you do decide to do something in regards, if you don't listen to that and you do decide to pursue something, go forward with that, at least both of you should have a partnership that is drawn up by a lawyer. This is not that's my best friend, that's my girlfriend, or that's my boyfriend. That's when that relationship ends, because you're both on the deed. That's when the problem starts.
Right. Yep. I call that the Mama Jen discussion. And I have had it happen so many times. And I don't care if the person is, 20s or 60s. I say, okay, I'm going to have a Mama Jen discussion. If you get married, or if you buy a house with a married spouse, there are legal documents already in place that says if this ends because of death or because of the end of the relationship, this is what's going to happen. That is not in place if you're buying it with a non-spouse. So you have to go and you have to get something written about it. And I say, and a lot of times it is romantically involved couples. And I say, I'm not saying that this is what's going to happen because your relationship ends. But if I go and buy a house and let's just say Tim and I bought a house, right? We're not married. And I pass away and we bought a house together. Tim now owns that house with my next of kin, which is 4 kids. He probably didn't want that. If it was reversed and he passed, then I own it with his daughters. And so it's a mess. And so I say you have to figure out what happens if the relationship ends. If there's a death, I tell them you better get you're buying it together because you can't afford it solo. So you better have a life insurance policy on each other. You better trust each other not to cause a situation where that pays out. Anyway, that's enough of my rant on that.
And last thing I was going to say, and the answer to that entire situation is get prepared. Follow the podcast that has been put together here.
Yeah.
Get prepared to buy the house the proper way. Again, I want to go back to a couple episodes ago. The house that you purchase, it becomes a curse, not a blessing.
Yeah.
So that's the answer.
I think we should have a lawyer on to talk about that as well, because engaged and dating couples and friends is really a thing. Well, I'll try and get a lawyer to come on. So another one I had is somebody had new construction. And they contracted in January. House is going to be done in May. Their car gets totaled in April. It's a work truck. They were tight on income to debt ratios, and they could not find a new one to do what they needed within their budget. The person who hit them had to pay for their loaner, their rental. And so I said, you're not lying to the insurance company when you say you can't find a vehicle that suits your needs. You can find it equipped the way you want, but if you buy it, you're not going to buy your house. Same thing with people who run out and buy furniture for their new house. I think I've got one more after this, two more. I had a friend at the closing table. Her young buyer said at the closing table, new house, I got a new car yesterday, I got new furniture, and I'm getting a new job because I told my boss yesterday to take this job and shove it. Lance, what happens there, Lance?
Well, they better hope the loan funded, because they got big problems in Little China.
That was at the closing table.
Yeah. Well, the loan funds later, typically after all the documents are going, you get to release the funds. That probably would be a null and void loan. It probably would be.
It was. It was. And at that point, you've lost earnest money, and you could be sued for specific performance.
So the do and don't here, don't change jobs during the process. If you not just at the closing table, if you change jobs during the process, we got big problems. So
yeah, because we've had people who've gotten offers to go, you and I have, who've gotten offers to go into management level. So their base salary, history major math, $75,000. Their new salary is going to be a $50,000 base, but they're going to get $50,000 in bonus. So they're making more money.
But you can't use the bonus.
But they're not, because it's bonus money.
Well, the other thing that I see in this situation too is a lot of people are stuck in their careers, and not taking the step to get out of being stuck in their career also seems to be the same problem that I'm finding in their finances. They're stuck in their finances. They're not taking the step. So at Aspire Coaching, we do now offer career coaching.
Oh, good.
And so that comparable behavior seems to be what I'm finding throughout.
That is 100% accurate. There's a phrase, and I don't like to use it because I don't believe it, but some people can't get out of their own way. And we say there are some people who are always going to be renters because they have habits they cannot break, thought processes really that they cannot break, that keep doing cyclical things that to them make sense, but will kibosh the whole ability to get out of debt, to buy a house, to better themselves, to do all the things. Last one, and then I'm turning it over to Lance. We had somebody who was buying a house. They owed child support in a different state, and they adamantly were like, you fill out like you owe whatever, blah, 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 blah. And they did not put it down. And they were incensed when the lender found it, different lender that I used before Lance, and it killed the whole deal like a week or two before close, because they were trying to get by with stuff. There's no fast way to make money generally that's going to be safe, and you can't get around things like this. All right, I'm pulling this down, and Lance, you can chat.
No, you're absolutely fine. So the first thing I want to start about is what we've been talking about is things that can upend your loan, things that can upend your approval. It can be before, during, or even after. When I talk about after, loan files are audited. They're audited by the government. They're audited by other entities. They're audited to see if the lender did their job in checking. They're audited to make sure the loan officer themselves didn't change things. They're audited to make sure the realtor wasn't mischievous. And they're audited to make sure that the borrower did not omit anything. Omittance, willful blindness is one of the things that we call it. So one of the keys to making sure that doesn't happen is what's called the URLA, or the 1003. That's the Uniform Residential Loan Application. It's a very long and cumbersome and overbearing document to consumers. Ours is digital. So when someone does a loan with me, they have it digital. Many people have seen this online. When you go to do a government form, like with the IRS or any type of government form, it's usually long and complicated and has all these boxes that don't make any sense. That's what an IRLA looks like. It's asking you who you are, how long you've lived someplace. But myself and many other lenders, at Fairway, we have an application called Fairway Now. It's fluid, it flows through. Hi Jennifer, thank you, Jennifer. What's your name? Where do you live? How long have you lived there?
Do you have other names?
Right. Do you have other names? Tell us about yourself. Have you filed bankruptcy? Have you given up a property in lieu of foreclosure? We'll talk about that at another time. Do you owe child support? Or do you, there's a lot of questions that ask. And I understand sometimes.
It's a proctology exam, Lance.
Yes, it is. And we need people to answer that
My
correctly.
favorite phrase about it.
Right. You may seem like you're getting a proctology exam, but just enjoy it.
Right. Well, no, I always say you're not asking questions because you're bored and want to get up in somebody's business. It's because you have to know for reasons. Mostly government, but whatever. We all hate it.
Sure. So there's some questions that a lot of people don't understand. So pitfalls. One of those pitfalls is income. People don't understand how they get paid. Mark will tell you that below. He's got people that feel like they make X, Y, Z, and he's like, either A, he has three answers. C, you're exactly right. B, you make a ton more than that. And more than likely, A, you don't make that much money. And let me explain why.
I will even add into that comment that I have a tremendous number of people that, one, don't even know when their paychecks are going to be delivered. Sometimes they get their paycheck actually 2 days before as a benefit to their bank. But here's another thing. I have people that, because everything is automated and direct deposited for the most part, I have people that have never, ever really even looked at their paycheck stubs, logging in and verified whether, and then they wonder why I didn't know that was going on. And so it's a number of, that's a great comment, Lance.
It's one of the top things we see is that people don't understand how they get paid. So they put down, I make X, Y, Z, and then we go into the process where the processor or me or the setup crew, we collect their documents to find out exactly what we help them understand. So one of the pitfalls is people don't know what they make right out of the gate. They go to other lenders online, they type in what you think, they get what they think is a pre-qualification, which is just throwing something up against the wall.
Paper.
Absolutely. So in that process, it talks about things like, do you pay child support? Do you own additional properties? Believe it or not, people forget that they own additional properties. They forget about that piece of land that their mother gave them that there's not a house on, but it's on the Gulf of America. It's down, but they still have taxes that are due on it, and they still have insurance that's due on it. And if it's down there on the Gulf Coast, even though it's just a piece of raw land, it's going to have some insurance added to it. And if that's $2,400 a year for that insurance, guess what? That's $200 a month that's going to be counted against their debt to income ratio. So just a few things. Another thing in the early, it asks about child support, back pay on child support. This is something that, oddly enough, we see a lot of people seem to forget about. I had a loan.
Conveniently, sometimes they forget to pay it when they're whatever.
That's a whole that's a whole nother conversation. But
actually, you know what, Lance? That is something to mention, because if you're not getting your child support payments as the recipient, you cannot count it as income. If you're not consistently getting them, and you're going to consistently continue to get them from the date of the loan plus 3 years, right?
Yes.
So
we have to have a 6-month continuous of getting that. And there's unfortunately some nefarious activity that happens with bad actors that for some reason miss the 6th payment.
Right. Well, and that's why you and I are going to do that Divorce This House course, so that we can help people before they get divorced structure things so that the payments are the same, but so that both parties moving forward can move forward with home ownership if they want.
So people are like, how could you forget about child support? We had a client last month that, not Jennifer and I, but I had a client a couple of months ago that they paid the child support with a business account. I don't know how they did it, but they didn't tell us about it, and we found it in the business account, and that's okay. We've now found it. We've now got a document. We're not reporting them to anyone. It's something that they are paying, but we had to count that against the income. So it's just, we want people to tell us as much as they can, and we ask a lot of questions. As she said, I'm not just sitting around trying to think of reasons to ask questions. There's reasons for them. You know, Jennifer, I've never told you this before. This next one I'm going to tell you, and Mark, you might find this interesting as well. A really good way to mess up your loan process is to dispute something on your credit during the process. An actual dispute. It will tie things up. So sometimes
for how long?
Could be for a long time, depending on who's doing the due diligence on it. Once the dispute is filed, then different parties can get involved. But we often look at that and try to get disputes. You know, if we do, you know, some coaching up front, let's get a look at that credit. If you're thinking about buying a house, by the way, anybody on here, it's a first-time home buyer or even a return home buyer. If you're thinking about doing something in the future, 6 months, 9 months, let's talk now. Let's find out some of these circumstances so we can avoid pitfalls and have you best positioned.
Well, yeah, because like I know people who have very common names like Matt Smith, Tim Jones, Tim Allen, you know, David, you know, Smith. And one of their protocols is to every year to 2 years run a credit report to see if one of those other hundreds of millions of people in the U.S. named that has gotten something on their stuff.
Here's something that I think would be, and I want you guys to speak to this. I think this is one thing that can help put a barrier in front. You know, I think you've mentioned talking about not taking on more credit. So for one of the things that you can do to build a barrier is every credit bureau offers a freeze on your credit, free freeze for a year. And that is, you know, as a financial coach, once again, we're trying to build, we're building a barrier to prevent you from doing that so that you don't mess up this loan process if that's what you're going through.
Absolutely.
It's a reminder.
Is that a good thing to do, Lance, during the process?
It is, and we're seeing a lot more of that. It's a good strategy to keep nefarious competitors away.
What about like when you have a child and, you know, these schools or hospitals or whatever has a breach of Social Security? Should you put a block on that too?
I don't know the answer. I would think yes.
Okay.
Mark, you could maybe do an episode on that. We got to keep it. Mark's got an appointment in 13 minutes, so I'm going to.
Sorry, my bad. Yeah.
So Mark mentioned it. Let's not run up more debt. Here's why we're not going to run up more debt. So when we pre-qualify someone, we're going to look at their past propensity to make a payment. It's their ATR, their ability to repay. And we do that by looking at their W-2s. If they're self-employed, we look at their tax returns, current pay stubs. Like Jennifer said, we're looking for a continuance to make sure that's moving forward. Well, one of the things that changes the ratio between what you pay and what you can afford to pay is the balances of your debt. So I'm going to put the word asterisk, unfortunately, in front of what I'm saying. Unfortunately, revolving credit plays a big part in what a person's credit score is, and it plays a big role in what type of mortgages they can get. The higher credit scores are afforded typically better rates, and the lower ones are programs with a little bit more restriction, and the rates are not so well. But when you rack up more debt or take on more revolving debt, the minimum payment adjusts. So the last few years, we've seen interest rates skyrocket. I think the average interest rate is 29% or 29.6%. I saw the other day. Mark. Go ahead.
That's true. Here's another thing that I'm finding is people will take a 0% interest credit card, not understand when that introductory period for the 0% comes off. And all of a sudden you're in the middle of a loan and, oh, gee, look at that. Our introductory just ran out and our interest rate went up to 24%. And my payment just went from $250 to $600. You know, because
I get caught with it. I'm so glad you said that, brother, because let's pull this up here. This will be a good experience for all of us. So Go ahead.
So 0% interest, but we have to understand, like Lance says, we have to understand 6-9 months down the road, where are you at? Anyone listening to this right now, if you have 0% interest credit cards, I want you to call and ask when your introductory period ends.
And so let's get the teaser. You say the 0%.
Yeah.
Look what it goes to.
There you go.
$29.9. Yeah. On all remaining balance, right?
Yes.
Yeah.
And there's fees.
And
that they
usually
can
you're
add
doing
on,
that
so-
and consolidating the loans. And that's the other thing too, Lance. If you're consolidating a loan, you've got 3 credit cards, you're putting them down to 2. You're closing credit cards in the middle of that. And we'll have to bring this up at another one because it drops your credit score potentially.
Yes, because what's happening potentially is you're killing a good history of debt. Remember,
Yep. I had somebody drop 30 points.
Yep. Remember, I said a second ago, unfortunately, asterisk. Yeah, when you close out that, if you're going to close an account with regard, and this is something Mark can help you with, and we probably have different fields of thought on this from a mortgage perspective. I'd rather you take it to $0 or $10 and have the wherewithal, the responsibility of oneself to keep it at that. I'd rather you do that instead of closing, because like Jennifer said, to my left here or to my right, it's going to drop 30 points, and that could take you out of contention for the right product that you want. Let me finish a few others.
It did. They worked for 11 months to get their credit improved, and we were 2 points away from being able to do the loan and get out of a rent. They dropped 30 points. 5 years ago, they're still renting.
Is that someone we're working with?
No.
They're
in the wind. They're in the wind. They're going to always be renters.
Jennifer and I have a lady we helped close about 14 months ago that we worked with for 4 or 5 years. And it was just life and things happening.
Loans.
Yep.
I know you got a few things to go through, and I know we're on a quick slant here, so I'm going to make this real quick. So debt consolidation companies, when you go to a debt consolidation company, what these people are going to do is actually obviously consolidate your debt, but you're going to get a loan. They're going to give you a loan. That's what their whole process is. And part of that process is to basically leverage and use their own power as a debt consolidation company on your behalf. Some of the times that they do this, they don't make those payments on time, and that can affect your credit score. That can affect what you're going through right now. So,
we really saw that about 10 years ago, after 2008, a lot of debt consolidation where to me, it was unfathomable that people would enter into such they didn't know what they were getting into. They're not really.
And I'm going to make an executive decision that, Mark, if you need to jump out, because I think there's a lot of things that Lance and I need to talk about on this one.
I will.
And we'll carry on.
Yep.
Because you got to get on a one-on-one with somebody with this too, because and again, call Aspire Coaching. If you're watching this, call Aspire Coaching. Jennifer Weisman with Benchmark, Lance Stanmeyer with Fairway Mortgage.
I'm gonna say I got to put the banner across the bottom there. We didn't have it up today. There it goes right there. So you can, Jennifer's at I Love My Tennessee Home, or on Instagram, or all those different places. And I'm coming up here, and then Mark will come up, and you can go to his website, and he helps people make these tough decisions that we're talking about. And of course, we all work with each other to advise each other and make sure that everyone's above board. So there it is.
And Mark, knowing how what Mark does may impact what Lance does, just like with the divorce, there's ways people do it, but maybe there's a more beneficial way regarding a loan. And speaking of that, before he leaves, Mark, next week, you're going to talk to us about how not to get derailed in the budgeting process when you are trying to put these steps in place so you can come to Lance and get a house.
Yeah, exactly. Absolutely. It's all about preparation.
So the next thing that was on my list is co-signing for a loan. Don't do this during the process, because you're basically taking on the debt of that person. It's not going to be ignored. There's some tips and tricks I can give you in the future for parents that have had to co-sign for a child, to help them get credit. This is a good thing to know, that if you do co-sign for like an auto loan for someone, once they show that they've made 12 months of those payments consecutively, and you can show that with canceled checks, in some cases with some loan programs, conventional, that can be ignored. Okay.
Well, that happened to me, Lance, with the house. Will's
Yep.
completely paid for it. And what I learned during this that I had no idea is Will made the payments from an account he opened when he was 16 and a minor child under my care, and I was still on that account. So what he's talking about didn't apply. So
It
the
looked like
next
she was
day,
saying it.
Ms. Weissman went out and took herself off that account. And Will got a big
Yeah.
boy account, and he's paying his own, and I'll be refinancing both those.
And that's part of the coaching. That's what Mark's going to discover. That's what I'm going to discover. That's what Jennifer's going to discover in open conversation. You know, those, luckily the three of us are professionals that, I mean, Jennifer's she's a 1 in a million. She's the ace in the hole. She has these types of conversations with people to prepare them so that they're not blindsided. Then she gets them to me. And you know what? Let's be honest. There's some things that I can't do. And there's other partners that Jennifer has to have to take care of those people. And I know what my shortfalls are. But she's got a great team around her of people that can help her. And she knows a guy or a gal. That's all
I do. I usually know a guy. And just like with most things, if you have to do something that's out of the box, time, money, and risk, there's a balance there. So if you can't do it in a conventional channel in a certain amount of time, you may have to end up paying more for it. And while you've got that loan that's higher and you got into the house that you needed to be, maybe you do what you should have done, but time didn't allow you to do with Mark ahead of time, and position yourself and get yourself off your child's account and all those things so that you can get it refinanced in a more traditional track at a better rate or what have you.
Yep.
So I'm gonna drop off here, you guys.
Sure.
But this has been fantastic. The information here is, if anyone listening to this right now, anyone that has said, "Oh, you know what, that's me," and you're not sure what to do, where to go. This team of the three of us will hone in and find the answers for you. We'll guide you. We'll work with you. And Lance, Jennifer, this conversation is just fantastic. It really is opened up a lot of conversations. So
yeah. Well, yeah, you don't know what you don't know if it's not your playground.
Yeah, one of the last things I was going to say is it's not easy. It's not easy to talk about these things. I want everyone that's listening to this right now to understand. I appreciate the vulnerability and the openness to talk about your finances with any one of us.
Yeah, non-judgmentally.
Right, non-judgmental.
And like the things that I've shared with the past clients, none of it was in judgment. It was more of a, like I tell my kids, learn from your mistakes or what happened to you, but learn from someone else's first.
Right.
Including mine, because I've made mistakes. Good Lord.
No, I'm not going to talk about mine.
Right. And I can probably share a story of something that I've been through that's very similar. So if you're listening to this, it's okay. And we'll guide you to get you to where you want to go with this team. Guys, you're awesome people. Love being here. And I'll see you on the next podcast.
Yep. Good luck to you and your client in your session. I know they'll do good things with you.
You bet. Okay. Bye, guys.
See ya.
Okay, that leaves us, Jennifer. Couple things that came up that I was just thinking of in the end there that are pitfalls that come up, and I don't know if we hear this anymore, but non-sufficient funds. So I'm sure everyone knows what NSF is, and it happens to eventually it happens to everyone. NSF is when a check is written and there are non-sufficient funds, and many times the bank will cover it now. About 15 years ago, there was some legislation that went through that helped consumers with that. And so now there are other accounts or maybe a credit line, but it still is put up as a non-sufficient fund. That will cause a massive problem when you're getting a loan, because you're going to have to be able to document why you had that insufficient fund. They're going to look back and see if you had other insufficient funds. That does happen. So every once in a while that comes up. Another thing I want to talk about, Jennifer, is that I don't think a lot of people know it, but no unsecured funds are ever allowed in a transaction.
What does that mean?
You can't use a credit card as your down payment. You can't use your Amex with a $50,000 limit to bring the down payment money, even though you can go to the ATM and get the cash. No unsecured funds are ever allowed.
So there's cash advances.
Correct. It's an unsecured Now you can do secured. You can have your home equity line, which is secured against the equity of another house or something that you own.
So if I need to do to take the money out of my home to put down on a second home or something, an investment property through a HELOC or a second mortgage, potentially. I'm sure there's caveats.
Here's another thing you can do. You're paid off cars. If you're short and it's not really a good time to do that. Interest rates aren't the best right now, but a couple of years ago when car rates were 1.99, you had a car that's paid off. You could refinance it. The cash that was withdrawn is a secured line, and you could use that because it was secured.
What about a 401k or an investment product?
That's a great question. You can use funds from that. You need to consult your financial advisor, but that would be a good episode for us to do because with a financial advisor,
I'll make a note on that too.
They probably won't do it because they don't want to put their name on. There are a lot of workarounds, and they're legal. They're completely above board. Have to do with taxation and withdrawing even from qualified plans. Definitely, I think you've seen this before. I've not done one, but about 10 years ago, we started to see, maybe about 7 years ago, we started to see a lot of, hey, buy a vacation home with your 401k. And it really wasn't a cash out, but somehow they were securing against people's 401ks to leverage for property. So that's something
you can buy an investment property in a self-directed IRA, and it's a really interesting thing to do, but you can't stay in it as a vacation home, or it's looked at as a disbursement. But and neither can your kids or your parents. Yeah. But if like you and I are good friends, we want to go buy vacation places down at 30A, you stay in mine for a accurate rental rate for a week. I stay in yours. And then when we turn 65, which I get to do before you, then we can stay in our own and it's not considered a distribution. And it's an interesting way to do some of those things. I've taken some CEs on it, but that's different than buying the vacation home.
It's interesting you brought that up, Jennifer, because one of the pitfalls that we look at, particularly with people with multiple investment properties, is we actually look at their Schedule E. And on their Schedule E at the very top is a days in use, where it talks about how many days was that home in service. And we sometimes run into discrepancies there where it's being called an investment home and it's really a second home, or it's a second home that's being called an investment home. And that's the wherewithal of the underwriter and the lender is to make sure that the numbers add up. And that's one of those things I don't think some consumers understand. We rarely.
Oh my gosh. Talk about the young kids we've talked to who want to buy an investment home and they're trying to do it as an owner occupied loan, and not always young kids. We've had grown adults trying to do it too.
Willful.
Well, how are they going to know? It's called mortgage fraud.
Yeah. And it is.
I'm not going to be a party to it.
I'm not really aware of in the last few years of people being arrested for it, but after 2008, there were quite a bit of people that were charged with crimes for structuring and things like that.
Even if they didn't arrest you, could you have implications where they made you sell it because you weren't doing it right and repay the loan, or fines, or?
They're probably jail time. I mean, when it's egregious enough.
Yeah.
I mean, it's been interesting. When I worked for the big banks, we did a lot of case studies like that, and it would get down, say this, and you can find this through the CFPB, CFP.gov or CFP.org, the Consumer Financial Protection Bureau. You can look at some of the goings on, and after I'm losing my train of thought, but digital, with all the new ways to prevent things, crime has gotten very high tech, and it's on the increase in real estate. It really is happening. I had something I wanted to say about tax returns or.
Well, while you think about that, I have another question about 401.
Sure.
If I've taken a loan from my 401k, not to put down on a house, but just because my company allowed me to do that and I had a hard time, maybe the economy this last years or whatever.
That's what I was going to say.
Does that come against my income to debt ratio?
Jennifer, do you know how some people say that we're like brother and sister?
Yeah.
That can read each other's thought? Because that's exactly what I was getting ready to say. So a perfect example of this, I'm going to simplify it to help people understand. So let's say that Jennifer works for ABC Realty, and she's a man. She's the broker, and she's salaried for some reason. And Jennifer's got $200,000 in her 401k. Something happens, I don't know, the last couple of years, times get tough. She's on top of her salary. She sold a lot of real estate, but things have slowed back a little bit. And either she has the opportunity to buy another property, or maybe one of her children needs help and she needs to take out $50,000 from her 401k as a loan. Okay. So Jennifer's question was, how will I have to show that or repay it? So it's going to show up two ways. Number one, since she's W-2 in our example, it's going to show up on her pay stub. It's going to show up as loan repayment.
Right.
People miss this all the time because it's quite easy for people to get to their money because it's no comment. It's easy to get to, and they forget that they owe it. And so that does get taken off of their income and adjusted against their debt to income ratio. The other way it's going to show up is going to be on their tax returns. They're going to see 1099.
But if you've seen tax returns and pay stubs, it's not going to be a surprise once you've given a pre-approval.
It's not going to be a surprise to this lender because of the way I do things. So many companies out there, Jennifer, just kind of get the basic information, say you're good to go. They go to write the offer, and then they try to figure out if the person qualifies. It's not how I play ball. But yes, you're right. I'm from day one that I'm talking to one of your clients. That night, they are sending, because you're preparing them. You're saying, you already just getting to know them. You're like, well, I know you're self-employed. Lance is going to want your tax returns. Oh, you're both W-2. He's probably not going to need them. He'll just need your W-2s. He can probably look the rest up online. That's how we do business at Fairway. We get this team does. We get everything up front. And when I pre-qual, when you get that letter on a Saturday, when you're doing a showing at 1 o'clock and you get the letter from my team at 12, everything's been looked at. And then, you know, you don't have to do this anymore, but new realtors that I work with, they're like, my client wants to know, what do they do now? I'm like, nothing. Don't quit. Don't quit.
Well, I do that in my buyer's orientation. I have a screen that looks like American Ninja Warriors. And I'm like, it's not a walk in the park. I literally say it's not a walk in the park, but let's not make it worse than it has to be. It's already a proctology exam. Don't open, close, consolidate credit. Don't buy. That includes don't buy a car. Don't get the discount for opening the credit. Yep. Don't forget to tell something. Don't deposit money unless you talk like and they still do it.
And it still happens to us, but we usually are able to work through it. We're actually at 45 minutes.
Yeah. There was something else I was going to ask you really quick, because it's in the news and we run into this a lot. Nashville is a heavy service industry. Tips. Claiming tips on taxes. A lot of people, and not an accountant, I have thoughts, but they don't claim all their tips. They only claim like their credit card tips. That lessens their ability to purchase because it's not as much income in their income to debt ratio. How do you think, with the new administration talking about not taxing tips, then everybody's going to show their tips and then that's extra income? Is that what we're like? I don't know. Is that the math? Is the mathing in the process?
I don't know.
Like if tips aren't taxed, then I'm going to show you my tips.
I think people are still very suspicious of authority and government.
And if it's going to change in 4 years or 8 years or 12 years. And now all of a sudden I'm making no tips again.
I think we'll go to digital before people raise their self-reporting, honestly.
Okay. Interesting.
I feel like people are suspicious. And by the way, once we get off this call,
don't be suspicious.
Once we get off this recording, we will be talking about an exact example close to your heart about that in a minute.
I thought we might be. That's why I brought that up. Okay, so speaking of episodes, so today we talked about hiccups in lending and show me the funding. Next week, Mark is going to be talking about setbacks and the savings and the preparing to buy and getting your credit straight. And what do you do so you don't get derailed and throw the cards in and go, I'm done. I'm never going to own. I'm, reactionary. Then we're going to go back through the steps to buying, then the app from app to funding, and then from not yet to yes. Then we have our first special guest. We've got them booked for 3 weeks, which I think is, right after Mark's not yet to yes. It might be the week before it. But Ashley Morgan with Foundation Title is going to come in and join us on the podcast and talk to us about things that come up in title and the difference between regular title and enhanced title. And then I think we're going to try and get a lawyer on and an accountant on. And maybe if we can, a financial planner. They're so heavily regulated, like you said, but maybe we can ask specific questions and get general answers on things. So, but again, if you have questions, please let us know. I had some questions that somebody asked me verbally, and I told them to send them to me, and I don't think they have. So I'll try and find those and get the answers
this out
up
on Facebook and remind them. But let's go ahead and end it, and we'll see you guys next week.
Take care until.